Hello, everyone. Welcome to week 12, the last and final week, bitter, sad, but true, of our 90-day to commitment for your financial future and your financial freedom. The last one is, of course, fitting. It is generational wealth. Why did we do all of this conversation, all of these videos? Why did we do it? Because, of course, our time on this earth is limited. So what is the point of saving? What is the point of investing? What is the point of doing everything that we went over? And the importance is being able to teach the next generation and pass everything that you've built onto them so that they are just that much closer to getting where you want it to be, or that much closer to advancing even further than you could in your lifetime. We always want to give a step up to the next generation so they can be better than we were, right? So that's why we did all of this. So the last part of this series is going over how you properly transfer all this wealth that you've generated, whether it's been over a 20-year term, a 10-year term, or only a year term. This is how you're able to transfer all that wealth. And maybe you went through the first part of the series and you're like, I can't do any of that. I'll never be able to save enough in order to leave what I want to leave for my kids or leave what I want to leave for my next generation. We also have a way that you can leave as much as you'd like to the next generation without having to save it all yourself. So we will be going into how you can do that as well. So Angie, I will let you start us off and go through our disclaimer that I think everyone's too familiar with, and then we'll proceed into the presentation.
Perfect. Thanks so much, Shay. So I'm Angie, if you don't already know, and Shay Osanami has been my beautiful partner and friend who has been a wealth of information going through this 12-week period. So yes, this is our last week. As far as the series is concerned, don't fret, you don't need to be, you can always get a hold of us. It does not need to be the end. So with this, for today's episode, before we get into the nuts and bolts, we want to have a disclaimer that the purpose of this presentation is to explain financial concepts and educate people about the decision they're making with their finances, but it's not intended for any sale or suggestion of any financial product, but rather to illustrate probable outcomes of these scenarios. During the presentations, we ask that you do not record or take pictures, and that's simply just to preserve the integrity of the information so that we can use it over and over again. Feel free to write notes, and if you have any questions, please get in contact with the person who invited you to this, or simply get in contact with either Shay or myself. Our contact information is in the comment section of the YouTube presentation. So what are we talking about when we say generational wealth? Well, that is basically wealth that is passed down from one generation to the next. So with your parents, it would have been what they were able to pass down to you. And if you have children, it's what you would be able to pass down to them, and so on and so forth. You may be familiar with it by the term family wealth or legacy wealth. If you're able to leave something behind for your children or grandchildren, then you are contributing to the growth of generational wealth in your family. So why is that so important? Why is generational wealth important? Well, it's estimated that 70% of families lose their wealth in the second generation, and 90% lose it in the third. So for example, your parents go through a traumatic event, such as divorce. Say your parents were divorced. Or say, for example, you lost one of your parents at a young age. Well, that would traumatically or dramatically affect the wealth that would be passed on to you. And same thing for your generation. If you yourself lose a spouse or go through divorce, Just as an example, that is then has the potential to dramatically affect the wealth that you are going to be able to pass down to your children or to those that are around you. So statistics like that, it may seem pointless to save for a legacy of wealth. In many cases, the loss of generational wealth can be prevented, though, through financial education. So despite what you might have gone through, what the generations before you may have gone through, it is possible to start right where you're at in order to change things for the better going forward. If you're starting from scratch with your finances or starting with a large debt burden, you should realize the importance of that generational wealth. Now, what if your parents have the ability to fund your education? This single action could have a tremendous effect on your financial future. You may not have that option, or you may think that you don't have that option. That's where we come in and we can look at certain things in order to pinpoint where things could be streamlined. The more you think about your financial life, the more you realize how important generational wealth can be. And if you have kids to plan for, then you can look at their future and possibly their children. So how do we go about building that generational wealth? Well, the best way to build for generational wealth is to take advantage of the wealth cycle process. So a major component of that process is to transfer between one generation towards the next. So Seg Funds or segregated funds is one great way to make sure that your wealth via investments goes directly to your loved ones via naming a beneficiary. Now, Seg Funds, I believe, are mostly for Canadians. In the States, you will have something that is annuities. So that's just a difference between one country to the next. But being that we're in Canada, we're going to speak directly to that. RESPs are another way that you can save for your children's education. I don't know that the States has that, but there are other opportunities in order to do so. Life insurance is a huge tool that can reduce financial loss or hardship in the event of premature death. I can attest to this personally, actually. I had a partner that passed away at a young age. He was 45, and it happened very suddenly. Had we not had insurance, I would have been looking at a very different scenario. I did have some other things that happened that I wasn't in the best scenario, but had I had the education, it would have been a lot different. A will. I cannot stress this enough. If you do not have a will in place, get on that, like stat. I don't care where you're at, what financial status you are in. A will is something that is extremely important as you think about your future. Oh. Sorry, I was just losing my screen for a moment. So the 3 phases of wealth. So the life cycle of building wealth can be simply understood in 3 phases. Accumulation. So in the better part of your years, in the first part of your years, you're going to be accumulating wealth. Then you go into the distribution and then estate transfer. With RESPs, in many cases, education can provide a way for your children to support themselves. With a college degree, it opens up opportunities to pursue higher paying jobs that can help them navigate their own finances. Anyone with an education will always have that education. Although there are other things in life that can come and go, no one can take away your knowledge. So you have that knowledge that is with you for the rest of your life. If you have the ability to help your children make it through college or university, whatever that education system looks like, then you're helping set them up for a brighter financial future. Let them have opportunities that you might not have, right? So it's about looking towards the future of those future generations. Seg funds. So here again, focusing on the Canadian aspect, the US is a little bit different, but segregated funds is a type of investment commonly used by Canadian insurance companies to manage individual variable annuity insurance products. It offers investment and life insurance benefits. Segregated funds must be held until maturity. An investor can choose to invest in a seg fund based on its investment objective and product terms. So some of these terms, some of these things that are listed on the screen may seem a little foreign for you. So please let us know so that we can help direct you in that area. That's what we're here for. That's what we're meant to do, is to help direct and guide you and help kind of break down some of these aspects. Segregated funds are forms of protection. You can protect your assets from creditors, as well as it allows you to bypass probate. Key, very key right there. That last one, if you take anything away from it, that's a game changer right there, okay? What the heck is probate? Well, probate is a term for a legal process in which a will is reviewed to determine whether it is valid and authentic. Probate is also referred to, it also refers to general administering of a deceased person's will, or the estate of a deceased person without a will. So again, something that's going to make this, first of all, a little bit smoother is having a will to begin with. If you do not have a will, it goes into what's called intestate. And trust me, now one other, sorry, I'm digressing here a little bit, but this is just another thing that is super important. If you do have a will in place, please make sure it is up to date. If you have left it for, say, 10 years, 20 years, a lot can change in that period of time. As you guys know, you could change partners, you could go through the loss of a person, you could go through a divorce. All of these things are very, very, very important, because what if you have a will in place and you've gone through a divorce and the beneficiary or the executor of that will is your ex? I don't think you want that. So please make sure that you go through that, okay? So on to the next thing. What's an annuity? Okay, so folks in the States, this is where you're going to want to cue in a little bit more. Annuities are financial products that offer a guaranteed income stream used primarily by retirees. Annuities exist first in an accumulation phase, whereby investors fund the product with either a lump sum or periodic payments. Again, if these terms seem overwhelming or foreign to you, please touch base with us, because we can help break that down for you, okay? Once the annuitization phase has been reached, the product begins paying out to the annuitant for either a fixed period of time or for the remaining lifetime. Now, let's put this into an example. Say you have an annuity in place, something happens in your life and it's like, oh my goodness, that's right, I forgot about this annuity. Well, you could have that in place, and it could mean the difference for you as far as an income coming in. Annuities can be structured into different kinds of instruments, immediate or deferred. So again, things to think about, whether it's right now, whether you have it in place, or you can put that into place. So these are just a few reasons why people buy into an insurance policy. A, to maintain your living standards, protect savings. Another way is to manage risk, look after your debt, or to decrease your debt, make sure that it's still being paid out on a continuous basis. It can protect you if you have a health issue down the road. It can look after what we've just been talking about, your wealth transfer or your legacy, your children. It can help in looking after your children, or perhaps a generational aspect. If you are self-employed or run a business, even a side business, this is key because it can look after so many different areas that you're not even aware of. What happens if, say you break your arm, say you're an administrative clerk, you break your arm. What if you're a hairstylist? Break your arm. You are now without an income. Life insurance has different aspects that can help protect you in that. All of this ties up into a nice little bow for your peace of mind. So the market difference trend, uninsured households. So 57% of families with children will have immediate financial trouble if the primary wage earner passes away. 50% of households believe that they are underinsured. Again, if you don't know, a lot of us just simply have no idea. It seems overwhelming, so we stick our head in the sand. And it's like, you know what, we figure that, you know, we're invincible, doesn't matter, or we just simply don't want to think about that morbid possibility. But we're always better off if we take a look at it, have somebody like Shay or I, or somebody that is aware of these things to help you plan. And 30% of households have no life insurance, which means they are not protected. How do you know? Do you need life insurance? Well, if you're not sure, and I think this applies to a lot of people, especially that 30% that we just spoke about, ask yourself these questions. How much do I contribute to my family's budget? If they pass away, will my survivors, so my partner, if you have one, my children, my dependents, will they be able to take care of themselves? This is a responsibility question, okay? Do I have any other dependents, such as parents, grandparents, siblings? Are they going to be looked after? A lot of people in, especially immigrants and people coming from overseas, but also what's happening more and more with the way the world is right now, we're getting sandwiched households where there's people that are looking after their children as well as their parents. Are those people going to be looked after? As a single parent, what kind of support payments am I receiving or paying? If I pass away, is this something that still needs to be looked after? How is that going to happen? Do I want my mortgage paid off in the event of passing, in the event of my passing? This is something that I can attest to. When my spouse passed away, if we didn't have any insurance, I would have been immediately responsible for almost $200,000 when I was making about under $30,000 a year. That happens, and it happens to people every single day. Do I want money put aside for my children's education? Do I want to leave money to anybody? Do I want to leave it if you don't have somebody that maybe dependents that you want to leave money to? What about a charitable organization? There could be tax benefits for this as well. Will I be leaving unpaid debts to people that are left behind? Again, I can attest to this, that I was living off of not Freedom 55, 65, 75. As few as 5 years ago, I was living on Freedom Dead. I was going to be leaving all of my debt if I passed away to anybody else. Well, it's just not very integrous and it's not very responsible. Will my business be affected if I pass away? What happens? These are all things that we can think about if we're thinking about life insurance. And it's not a one size fits all. You are a unique person, and so should your life insurance. It's not just about getting a product that, okay, this is good for anybody. We tailor it to fit what you are going through. What are your needs? So Shay, do you want to pop in and explain, how does this all work? How does life insurance come in and how do we make it work for everybody?
Absolutely. So with life insurance, like any type of insurance, it works by spreading financial risk among a large group of people. So you're paying into a pool fund, and then whoever makes a claim on the insurance, the pool fund is paid out to that individual. So think of it like depositing money into a safety net, and then that will be safeguarded it will safeguard your loved ones, pardon me, and your assets, and it will repay your debts when you no longer can. So you may have heard from your family and friends that getting life insurance at a young age benefits you. You may have wondered why. Why would I get it when I'm healthy and young? Wouldn't I get it later on when I have kids and when I'm actually established? So why you want to get it at a young age is it's always more affordable at that time. Insurance is calculated based on things like your age, your gender, your weight, your medical history. So the sooner you can get it and lock in at that young, healthy, nothing's wrong, your prime chicken age, then that helps to make sure that there's not going to be any issues as far as getting you covered, number one. And number two is going to make sure that it's affordable. And then you can lock it in for a certain period of time. You can either lock it in for your whole lifetime, doing a permanent coverage, or you can lock it in for a term. So sometimes I say lock it in until you think about the age you're going to have children, and then we can revisit. So if you're in your 20s, maybe you don't think you're going to have kids until you're 30, you can always lock in a 10-year term. And then when you have children, we can revisit that situation. Or you can lock in at 20 for a term of until you're at age 100. And then it's one and done. You never have to think about it again. Now, with your life insurance policy, it is a contract between you and the insurer, and you are agreeing to pay a fee called a premium, and the insurer is agreeing to pay whatever amount you choose upon your passing as a benefit, tax-free, to whoever you name as your beneficiary. Now, this can help with funeral costs. This can help cover any student loans or debts you have left over. You can also just donate to charity if you want, or leave it to a loved one. But this helps to make sure that everything's squared away so that whatever you have in your possession that you want to leave as far as heirlooms or your house, that actually goes to your beneficiary. If you leave debt behind, they sell off your assets to pay off your debts. And sometimes that makes it result in you leaving your loved ones with nothing. So having a life insurance in place will just make sure that everything's squared away. And if you didn't have the privilege or the benefit of being able to set aside enough of yourself personally via investments, insurance gives you that ability to still leave the monetary amount that you want to leave to your loved ones without having to save it all yourself dollar for dollar. So I mentioned a premium. How do we figure that out, right? So insurance is purchased per 1,000, which is one unit. So my chart here is a little off because it's based on 10,000. So if you bought $100,000 worth of coverage, then you'd be looking at Depending on where you're at, you just move the decimal place one spot over. So $100,000 worth of insurance could be $5.30. It could be $6.50, and so on. And then, unfortunately, if you are a smoker, that does increase your risk of having a premature death. So it does almost double in price at times. But there are some companies that are a little bit more lenient when it comes to smokers. So even if you are a smoker, there is options out there as far as still getting affordable coverage. You buy insurance per unit, and then the cost of insurance is based on that 1,000 variable. And it goes off of age, the sex, smoker, non-smoker, the status of your health, and many more, just like your medical records, family history, and things like that. They'll also do a mortality table. This is also known as a life table. This is going to show the rate of death occurring in different populations at different time intervals, the survival rate from birth to death. And this table is what actuarians use to kind of figure out where you fall as far as a premium value. I know it sounds a little morbid, but it has to be fair to both parties. At the end of the day, there's a lot of the times where you're never paying the insurer the amount that they're paying out for the benefit. Imagine if, and we've had situations like this happen. I haven't experienced it myself personally yet, thank the Lord, but if you purchased an insurance policy for $500,000 to be given to your two kids in the event of something happening, and you pay one premium of $30, and then something happens that month, and you get in a car accident, you pass away, that $500,000 is given to your two children, and you've only paid $30 of it. So they need to figure out how to make sure that they stay afloat to cover everyone's benefits while also making it fair to you as well. So that's where this table comes in, to just kind of figure out a happy medium for that. So you figure out how much roughly it's going to cost. You figure out what a premium is. Now you need to figure out how much you need, so we can go back and figure out what that would cost for a premium. So what we use for that is called the dime method. You can calculate how much life insurance you need to protect your family by using this simple method. So buying insurance to have enough coverage for potential loss. You never want to buy $100,000 worth of coverage if you have a $500,000 house, because that's not going to cover everything, right? You don't want to buy a $5,000 insurance if you only have $100,000 worth of debt and no house, because that's kind of over coveraging, unless of course you want to leave some to your family, or you have dependents, right? So how we figure out this dime method is we take the debt, which is a sum of all of your debts, exempting your mortgage, and we add in any predicted funeral costs, which I will be going over as well. And then we go over income, which is your yearly income multiplied by the number of years you believe your family would need support. So if your kids are 8, then they would need support probably for the next 10 years, right? So you would factor that in. You want to put it in your mortgage, so calculate how much it would cost to pay off your mortgage. And then your education, calculate the cost that you want to incorporate as far as sending your kids to school. You want to make sure you factor all of that in. And then you add that up, and then you can have your spouse do the same. And then you guys are both covered for your contributions into the budget. So once you determine the amount of coverage that's right for you as far as the dollar amount, then we go back into the cost of insurance and we figure out how much that premium would be. Now, if we figure out the premium is maybe an amount that is too much, then we restructure the amount that you decided to cover yourself for. So we can always adjust it and then make plans on how we can pay off some debts. So then you don't have to incorporate that into your life insurance. Or maybe we do a term instead of a longer period of time. So then it just gives you that 10 years to kind of get caught up. And then in the next 10 years, we can restructure it again. So there's lots of different ways to make sure that it's affordable to you, but it also gives you what you need as well. Now, premiums can be paid on an annual basis. They can be paid on a quarterly, a monthly, even a bi-weekly with some companies as well. So there's lots of ways to make sure that it's affordable and practical for your lifestyle. Now, with insurance, like I mentioned, why get it young? It's because of that annual renewable term, but that only works if you first get initiated into the term, and then you can continue to auto renew every single term and continue to have that guaranteed insurability. So with the auto renewable term, it offers a guaranteed reinsurability for the future set period of years. During that period of time, the policyholder will be able to renew each year or every 10 or 20 years without having to go through all the reapplication process and take another medical exam to be reinsured. So if, let's say, you got insurance at 20 and then at 30 you had cancer, but you already had that insurance in place, you'll be able to auto renew it without having to tell them now that you have cancer and get prorated and be charged more for the coverage. So like I mentioned, you can get it for a long period of time or a short period of time. If you don't want it for a permanent plan, or maybe you're just getting it while your kids are young, and then once they move on and they're stable, you're not going to worry about it as much. You can just get a term. Terms are also great. I know we mentioned this previously, if you have a mortgage. Lots of people don't know that with mortgage insurance, your money, if something happens to you, it goes to the bank, and the bank decides how they deal with it, and it decreases over time. So if you buy a mortgage insurance for your house at 250,000 to cover, well, that's not realistic now, I guess. Most houses are 450,000, but if you bought a mortgage insurance for 450,000 and now you're paying down your house, that benefit is going down too, but your price isn't. The amount you pay isn't. So the benefit value is slowly going down as you pay down your mortgage, and you're not really benefiting from that. Now, when you pass away, if something happens prematurely, all of that money that's left in that insurance policy goes to the bank to pay off the mortgage. But what if that person still wants to live there? What if you have debts left over? That person's responsible to kind of figure all that stuff out. But with a term insurance, you can get it for the value of your house. You can name your loved one who is supporting you in the house as the beneficiary. That money all goes towards your loved one, and then they can choose to just pay the mortgage monthly like they were doing before, and use the rest to maybe just take some time off work and grieve, or to pay off any debts you had remaining, or to take care of the kids. They get to decide what happens to that funds, and it doesn't decrease over time. It stays consistent. So the one last thing that I will mention, actually, because it is a nice perk, is that every single time you move homes, you won't have to change this policy unless your home increases. So with the mortgage insurance, every single time you leave that home and go to the next, you have to get a new mortgage insurance. With life insurance, if you go from a $450,000 home to a $450,000 home, you don't have to renew that. You can just transfer it to the next home. Or if you go to a house that's now less than the previous house, you now have kind of equity in your insurance in a sense, and you'll be leaving way more than what you owe. And then that just starts becoming money that you can leave to your kids or to pay for their education. It's a surplus, which is always a good thing. So back to my presentation here, or our presentation here. So with term insurance, it's simply a type of insurance, almost like renting an apartment. You kind of rent to have an insurance for a certain period of time instead of owning the insurance policy permanently. So when the insurance company will pay out a death benefit should anything happen in a certain period of time. So you have a couple options. You have an annual premium, which every year the premium is going to go up. Now, like I mentioned, it goes based on your health, your age, your gender, everything like that, right? So if you're locking in only for a year, you're going to be reevaluated every single year, but you're going to be guaranteed insurability if you lock in a certain period of time, okay? Now, with a 5-year, you're going to be paying a consistent premium for 5 years. Then when it comes to renewal time, they'll rejudge based on your age at that time. And then they'll do it again. And then they'll do it again every 5 years. But through those 5 years, that premium will be consistent. 10 years, lock in for 10 years. Every 10 years, you'll be reevaluated at the age you're at, but your health will not be the question. And you can do 20 years all the way up to 30 years. Now, what's the benefit of choosing each term? So if you look at the chart here, the column that would be going vertical is the price or cost of premium. So it starts off to be cheaper going on a shorter period of term, but then what happens sometimes is once you go higher in age, it becomes unaffordable. So then you can go to 5 years. It's a little bit more expensive at the beginning, but then you're locking in that price at 5 years. So then you know that you'll be able to afford it for 5 years if you can afford it now. Same for the 10, it's a little bit more expensive at first, but then if you compare it to the 5 years, it kind of stays in between. So it ends up being a little cheaper later on. And same with the 20. If you compare these two, it's a little cheaper at the end, at the tail end of the term to do 20 years than it is at the term 10. So what are the advantages of doing term? What is the disadvantage? The advantage is that ability to have the coverage you're looking for at that lower cost premium. It's a way to temporarily cover you. Maybe you know in the next 10 years, you're not going to have as much debt as you have right now, but you need to cover your debt if something happens. A term is great for that. Now, the disadvantage is the risk of being uninsured if you're ever forced to cancel your policy due to the high premiums. The maximum age of a term only goes up to about 65 or 75. Well, what if you live until 85? If we're doing that generational wealth transfer, we want to have something permanent in place to make sure that we don't outlive our policy, right? You never want to hope that you pass away at a certain age, right? You want to just enjoy life. So a permanent policy gives you that ability. Policies will lapse if a premium payment is missed. So you want to make sure that it's something that you can consistently afford. You don't want it to be a stressful payment, but you just want to know that you have that peace of mind. It's like car insurance, right? You hope you never use it, but if you need it, you're happy it's there. So we want to make sure that it's something that we can consistently afford. And then the last thing that some find a disadvantage is that after, let's say you buy a term 10, if you never use it, it kind of feels like that money was wasted. So when you do a longer period of term, it is more likely that it will be used, and in which case it is a good investment to go with. So maybe you were looking at this and being like, term doesn't seem quite right. What I'm trying to do is I'm trying to transfer my money to the next generation. I don't want to worry about if I live past 75. Then doing a whole life might be an option for you. So what is a whole life and why would anyone choose a term over a whole life? Whole lives are a little bit more expensive, but how they work is they give you a fixed premium over your whole lifetime. It's permanent, it's locked in, and it's a lot more initially, but then at the end of your life, when you're approaching 50s, 60s, 70s, it's a lot more affordable than it would be if you were doing a term. So to give you an idea, a $50 policy in your 20s could turn into being a $400 a month policy or a $500 a month policy in your 60s as it goes up, right? Some people can't afford to do a $200 policy a month. But if you locked into a whole life at 20, it might only be $80 a month continually for your whole lifetime, or $100 a month continually for your whole lifetime. So you'll know what that payment is until age 100. Or you can choose to pay it for 20 years and then not have to pay it again, but your insurance is locked in and you have it. So that's another thing to think of. If you lock in at age 20, you can be paying for insurance until age 40. And then when you retire, you don't have to worry about an insurance payment, but you know that that benefit's there. So that's another idea to keep in mind. And that's why education for the next generation is so important, because so many of us don't think about these things in our 20s. And then by the time you get to 30, well, now you are paying insurance till you're 50 and you're locking in a more expensive premium and so on and so forth. So talking about these things, you can get insurance as soon as 2 weeks. Okay. Talking about these things is so important. So it builds up what is also called a cash value. Now, with your cash value, it will also build almost like an investment portion with your whole life. So whole life insurance is a policy, and let me just move my screen here. whole life insurance is a policy that keeps you safe for your entire life. So part of your premium purchase will go towards the insurance, and then some of it will go towards a cash value. So it'll be a fixed level premium for your whole life. So it'll always stay the same. It is low guaranteed interest on the cash value, but it is gaining interest. You can access the cash value through withdrawals, surrendering the policy, or you can actually take a loan on your insurance, and you can use that cash value while you're living. So it's a way that you can have a kind of a living component to your life insurance, which kind of gives you a feeling of that is a little bit more useful, because life insurance is kind of for the next generation, right? You don't really get to benefit from it, but you know that you're going to be benefiting others. The policy can also sometimes pay a dividend, depending on what you pick, to the owner of the policy. Now, another option for permanent coverage is universal life. So universal life is a hybrid between whole life and term. It's designed to last your entire life, but it has flexible premiums, which means that you can, if you can't afford a whole life initially, you can do a universal life. It's still a permanent, but your premiums are flexed. So maybe you start at your 20s when you're not financially established, but you want insurance. Then it'll be cheaper in your 20s and then gradually increase in your 40s and your 30s when maybe you are going to be more financially established. So if you think your finances are going to increase over that period of time, universal might make more sense for you. Some premiums pay for the cost of insurance, and then others go towards an investment fund that is incorporated into your insurance. It allows for flexible investment choices, and you can access the cash value via a withdrawal or by a policy loan as well. So what kind of happens with universal life insurance is you have the ability to overfund it initially. And then down the road, if you can afford to cover the cost of insurance, you can take out from the investments that you kind of overfunded in and then use that to pay the cost of insurance. So then at the end of your policy, you're not actually paying for your insurance anymore. It's kind of paying for itself. So it's kind of like an investment where if you're pulling out the yearly amount, it's going to kind of regenerate every single year. I hope that makes sense. If you need more clarification on that, definitely let Angie and I know. We can hop in a call with you and dive into that deeper. I feel like I could do an hour session on every single one of these small incorporated parts, but I don't want to overwhelm any of you guys. So if you don't want to know more, just let us know and we can dive deeper. So you have these two permanent options. Which one would suit you the most? So with a whole life, if you want to just know what your payments are, just tell me what it is, tell me how long I have to pay, and I'll do it. You want to go whole life. If you're like, look, I can't afford much right now, but I know I'll be able to afford more later, you're more universal. If you want to know exactly how much you're going to end up with for the death benefit, whole life makes more sense. If you want to kind of shoot for the wall and see if you can maximize your growth and have it in more aggressive portfolios, universal makes more sense. Both are creditor protected. Both can be for a person or a corporation. Both are tax deferred growth and tax free death benefits. Okay. So who do you leave it to? Like Angie mentioned, you can leave it to a loved one. You can leave it to a dependent. You can leave it just to your estate and make sure that everything's all squared away. You can also just leave it to charity. Maybe some of you are like, I don't have anyone to leave it to. Like, I don't have any kids. Everyone else is good. That's okay. Find a charity that will speak to you and leave it to them. Know that you're leaving the world in a better place. Or maybe just do enough to cover your debts so that you know you're not leaving the world any worse than when you came in, right? So your beneficiary is who you name on your life insurance policy, and it's who the money or the death benefit would be going to. It goes directly to them, and you are able to let the beneficiary know how you want, what you want the purpose of the money for, or it can be their own purpose. And making sure that your beneficiary knows how you want the death benefit used, if there is a purpose to it, is very key. And that's where a will comes in. So estate planning. What is an estate? So an estate is an economic evaluation of all of your investments, your assets, your interest of an individual. It's what you've all accumulated in the accumulation phase of the wealth cycle. This is how we determine the distribution of everything that you've built for yourself. Now, the estate includes your belongings, your physical and intangible assets, your land, your real estate, your investments, collectibles, furniture. Estate planning refers to the management of how all your assets are transferred to your loved ones and your beneficiaries in the event of your passing. Estate taxes may be levied on the value of one's estate at death, but any death you leave behind via capital gains or estate administration fees, which can be that probate, is covered by your assets, or it's settled with your estate. So your estate will be paying off your debts with any assets that you have on hand. Your house could be sold, your cottage, your car, and other investments could be used to all settle your debt if you don't have life insurance. If your estate doesn't have enough to pay your debts, it will be considered insolvent, which means your debts cannot be paid. Now, your actual debts are not passed down to the ones you love necessarily, but if you have a spouse that is intending to live in the house still, if you pass, the bank could say, hey, we need this to pay off your wife's debt or your wife's debt, so get out. And they'll sell the house and use that to pay off the debt. That can happen, but they're not going to give you a bill just for a credit card she didn't pay off. So that's one good thing to keep in mind. But if you want everything to stay the same once you pass, that's something that you might need to consider. The other thing that they can do is they can go over and take away from the estates of your loved ones. So those estates of your loved ones can be affected. So maybe you're like, look, I don't really have any debt. My house is paid off. My car is paid off. Why else would I need a whole life? Or why else would I need a term insurance? Funeral costs. So if you want to do a cremation, you're not looking at that much debt that you're putting your family in, maybe 5,000. But if you want to have a nice funeral, and I'm sure your loved ones don't want to bury you in a hole in the ground in the backyard, they want to give you a proper burial, a proper celebration. So if you want to do a high-end burial and get a nice casket and tombstone and all of that, you could be looking at $15,000 for that. Do you want that $15,000 being now placed on your grieving family and loved ones? Or do you want to make sure that that's taken care of? You have a will that's dictates exactly how you want your funeral to be, what type of burial you want. There's no guesswork. There's no confusion. Then that is something that you might want to consider to set up with your will and with life insurance. Sometimes it's just a matter of covering the funeral costs, which makes it a very affordable insurance to have. It doesn't always have to cover your debts and everything else. It can just cover what you want. Now, a will. A will is a document that takes proof for your wishes and follows that written consent for your death. So it will make note of everything that you want done, and everyone will have to follow it to a T. This person gets this person gets this. When I die, I want to be buried next to here, and I want to be turned into a tree or what have you. You can let everyone know what you would like. Now, the executors are people that now it's nice to have one or two, maybe the second one to look over the first one, but the first one to look over the second one, just to make sure everything gets done, that you've chosen to look after your affairs, someone that's going to have your best interest at mind. And the executor is going to make sure that he, like the name explains, executes all of your wishes and make sure that everything gets done. So protecting your estate, that will is going to make sure that everything you want done with your possessions and with everything that you've accumulated over your lifetime, your memory, your legacy, is number one, kept intact, but also goes to the people that you want it to go to. People get kind of funny when there's money with no name on it. If you've ever had a $5 bill go on the ground, you're like, oh, did anyone lose a five? Now everyone's down a $5 bill and they're like, oh yeah, that's mine. Oh yeah, that's mine. Oh yeah, right. And sometimes you get a little loopy at the end of your lifetime and you promise your diamond necklace to 7 people, or you promise your house to 2 different individuals or whatever, right? So having it written down and just saying, this person gets this person gets this, you can make sure, number one, that it's fair. So you can kind of equate everything and make sure everyone's getting the right amount. And you can make sure that you don't forget about anyone. Consider a trust. If you hold your properties in a living trust, your estate would not have to go through probate. So again, saves you a step. Probate takes a while. It takes a while to process. So anything that you can bypass probate and just give straight to the loved one individual is going to save on taxes, is going to save on time, and just manpower. Have a healthcare directive. Hospitals have forms where if you are unable to make a decision for yourself, that you will have a chance to name someone that will make decisions on your behalf. So make sure you have someone that's going to look after you if you are unable to kind of verbally consent to those things yourself. And power of attorney. You give a trusted person the authority to handle your financial property and handle your finances in a proper way if you are unable to or incapacitated. Now, in summary of this whole series that we did, the idea is just to create a plan for your now, create a plan for your future, and create a plan for the next generation to come and their future. Always know that even if you think it's too late for you, it's not too late for the next generation. Find a niece if you don't have a kid of your own. Find a foster family, find a charity, and just leave the world a better place than the way you left it. Obtain the right amount of coverage that is good for you, your family, based on just affordability, based on need, based on where you're trying to go. Sometimes you have to pass the baton. So if you want your children to get to where you want to go and maybe you didn't get there, give them a head start. Let them start from where you left off. And in your will, dictate, I want you to go to school. I want to make sure that your school is paid for. I want to make sure that you had a home. So I want this money to be saved until 25 and have a down payment on a home. Dictate how you want that next generation to go. Find a right tax strategy that fits your retirement, your wealth goals, that just gets you those stepping stones to where what you're trying to achieve for your family name. Protect your estate, create a will, make sure that everything that you've accumulated gets distributed the way you want. Build that legacy, make your name last, make your name continue for generations to come. I want to grab a book. I didn't think of this when I was making the video, but it's an amazing book to read. And it's this one here. Rich is a State of Mind. Now, if you ever have a chance to purchase this book on Amazon, or you might be able to find a free PDF somewhere or a YouTube audio, this gentleman had created a solid, amazing financial plan for himself. And what this book talks about is when this gentleman passed, he was kind of a penny pincher his whole life. And people kind of were like, oh, this guy, like they never really thought anything of him. And then when he passed, he had everything down to the T. He crossed his T's, dotted his I's, and everything. I believe he had like millions was distributed. And it was just a pain-free process. And everything was allocated and organized and structured. And he just had it all tied in a neat little bow. And it just surprised his loved ones because there was no confusion upon his death. There was no stress. It was all just handled. And this is what we're trying to help you guys do, so that when that time comes, you're leaving no stress behind. It's only joy and a celebration of life. So that is our video for the generational wealth. I hope that you guys learned something from it. I hope you guys learned something from this whole process. I hope this is not the last video that you guys see from us. In the comments, especially on this video, please let us know if there's anything else that you want us to discuss, any other topics you want us to dive into. Angie and I will try to strategize and come up with some new topics for you guys. But if there's anything you specifically want us to talk about, I would love to hear it. like, subscribe, and actually definitely subscribe now, because it won't be maybe every Wednesday night that we do. We might just do pop-up videos every now and then. So definitely subscribe so you get notified when we post those videos. But I want to thank you guys so much for your time, your attention, and for joining us on this journey. I'm going to pass it back to Angie to close us off.
Thank you so much, Shay. I can't believe it. The journey is at this stage already, 12 weeks plus a little bit. And wow, we've gone through an awful lot. So yes, thank you so much for coming along for the ride. Now, if you are just joining for this particular video, know that there are 11 before it. And go check out the playlist, because they are all in, they're all saved there, and it says which video you are currently on. Yes, if there's any topics that you are specifically interested in regards to financial matters, wealth concepts, investments, etc., make sure to put a note or contact us via the contact info that is in the comment or description area. And know that we got your back. Know that we're here for you to help tomorrow be just a little bit better than today. So you may start off as awesome today, but we want tomorrow to be even awesomer. So that's a word from Angie's dictionary. And so again, thank you so much. And thank you, Shay, for helping to put together this amazing series. I love that we can get together, and knowledge is something that you can't take away. So that's what we're here for, is to empower, educate, and elevate you so that you can take and better yourself, so that you can pass it along to the next generation. So thank you again. Make sure that you like, subscribe, and comment. And on that note, we're going to let you go and hope to see you soon.